I want to thank everybody for coming or joining us today on the Friday, taking time out of their day to listen to Garrett and I talk about amazing financial stuff, which we're so excited about. But I want to thank Garrett Melson for joining us from the Texas. Garrett's a CFA. I listened to some of his stuff. And as a kind of a takeaway, what we try to do with these calls is introduce the clients to the people that we have access to and that who are guiding us and helping us become stewards of your money. So these are the people that we rely on in regards to making decisions and things of that nature. So without further ado, I'm going to introduce Garrett Melson. I'm going to start asking a couple questions, Garrett. And I would be remiss not to ask the probably biggest question of the day. Do you have any thoughts in regards to the strike that just happened? It's unprecedented. That never happened before, right? So do you have any thoughts in regards to the strike that's going on?
Yeah, of course. I mean, I think a lot of people are focused on that. The headlines are going to be a little spooky, especially as we, recently have seen a little bit of stickiness in the inflation data. Maybe we'll touch on that in a moment. But the broad theme still continues that we're still in a downward trend in inflation. And I expect that to continue as we move into year end and into next year. There's obviously concerns that this might ramp up some of those inflationary pressures. Think of not only the fact that it's going to obviously constrain some of the production for some of the automakers, but then on the flip side, the potential result here is increased wages, which I think a lot of people are fearful of filtering back into the inflation data. I think just broadly, wage growth is decelerating as the labor markets normalize, and so is there going to be some, or are there going to be some bumps along the way? Sure. But ultimately, that just makes for a more resilient economy, I think, if you have stronger wages for consumers here. So I view this more as kind of a short-term headline risk. Ultimately, if it gets resolved, keep in mind, they're still working towards a resolution here. And so it's not a full-on strike yet. It's kind of being phased in. Hopefully, we can reach a resolution quickly. And ultimately, any lost production now is just going to be made up in subsequent quarters here. So from a growth perspective, probably not going to be a whole lot of a lasting impact here. So again, kind of a short-term headline risk more than anything that I think really changes the trajectory from an inflation and a growth perspective in our eyes.
So I hear you're not really concerned. It's kind of normal business process that these things happen, just work through them and kind of don't pay attention to the headlines, just kind of stick with your plan.
Yeah,
so,
headline risk, but I think ultimately it settles out.
I love that term, headline risk. I'm going to start using it. Actually, it kind of captures a lot of the stuff that people get nervous about, which kind of leads into my next topic. I did some Google searches before we kind of got on here, and one of the number one Google search was financial crisis. Are we in a financial crisis? Are we going to have a 2008 financial crisis type scenario? Is the housing market going to blow up like it did in 2008 type scenarios? Are you guys concerned about any of that stuff, or is it kind of a more headline risk too?
To be honest, I wouldn't even pin that one as headline risk. I would view that more as there's still a lot of PTSD from the financial crisis, even over a decade ago. So a lot of people still kind of view that as the framework where they look through, looming risks here. When you consider where the economy is, from a starting point, it couldn't be any different than it was coming into the financial crisis. And I'd namely say, take a look at household balance sheets. They are very, very robust. Yes, there have been some pressures, especially at lower incomes over the last, couple of years because of inflation, but wages have been growing too. So ultimately, we were at a much further stretched place from a leverage perspective coming into 2008. And again, that's not the type of scenario that I think you need to be concerned with on the downside. Could we see growth continue to slow down? Sure, but a looming financial crisis just really isn't in the cards right now. You just don't have the preconditions for that. If anything, the strength of the consumer balance sheet, and you can, extrapolate that to the corporate balance sheet as well, they're very robust. And so what made the financial crisis and the recovery so painful is that long period of paying down debt, repairing balance sheets. You wouldn't need that type of dynamic right now. So I think a lot of those fears are overdone. And the housing market too, completely different place right now. The reason why the housing market's not so healthy isn't because you're seeing, again, excesses there. It's because we don't have enough supply. And at the same time, a lot of that existing supply of homes, not new homes, is basically locked down because a lot of household owners are locked into low rate mortgages with, 3%, maybe even below 3%. And so that's really the issue. It's a lack of supply, which if you think from a growth perspective, we need to build more. That ultimately is going to be support for growth over the long run. So again, it's hard to shake these kind of, prior experiences. They get really emblazoned in investors' minds, and it's hard to disabuse them of those kind of looming risks. But the backdrop right now couldn't be any different than it was coming into 2008. So we really view that as not a meaningful risk from here.
That'd be great. Yeah. You made a comment that I actually love. I kind of want to dive into a little bit more, but you made a comment in regards to the consumer balance sheet. Now I know there's some headlines saying in regards to the consumer balance sheet that, hey, the cash of the consumer has gone down, but the balance sheet's still strong. Can you elaborate on kind of what your guys' definition of what that means, and not the headline mumbo jumbo, how the balance sheet's stronger than what it was, or just repurposed?
Yeah, so I think there's a few things to unpack there quickly. The first one is the cash drawdown. So you hear a lot over the past couple of years of this idea of excess savings, and it's kind of a strange term, but basically the idea is that savings rates surged during the early stages of the pandemic, not just because people were fearful of a serious recession and slowdown, so they naturally pared back spending and saved a little bit more. But the flip side of it was, well, we couldn't necessarily spend as much as we'd like to, especially on the services side of the economy, because it was locked down. We did our best to redirect that spending towards goods, but there's only so many things you can buy on Amazon until you get tired of breaking down boxes. So ultimately, what you saw, pair that with a lot of the strong fiscal response from the government, stimulus checks, enhanced unemployment benefits, that led to a huge surge in what was kind of considered excess savings above what the savings rate was prior to the pandemic. And so over time, as the economy's recovered, consumers have been pretty confident. They've been spending and they've been drawing down on some of those savings. So the savings rate's fallen, and we've kind of tapped into those excess savings. But that's kind of a temporary phenomenon. And, depending on your estimates, there might still be some more to juice there. But ultimately, when you look at the cycle, what drives consumption, especially over the last couple of years, maybe even more so than normal, it's just income. People spending their income. And so again, you're not seeing really tapping into anything beyond those excess savings, and you're not seeing really a lot of increased leverage for the household. So that's what we really focus on, not just kind of one side of the household balance sheet. Leverage on one side, the credit card, mortgage debt, auto loans. That's one side. But on the other side, think about your assets. Home prices have gone up dramatically. Asset prices, even with the pullback last year, we've recovered a lot of that this year. And again, if you take a look at some of the data for checking account balances, they're still about $3 trillion above where they were prior to the pandemic. That is a lot of strength on the asset side of the balance sheet. And so when you think about, I think one of the best ways to measure the balance sheet strength, what is your kind of ongoing debt servicing cost? So how much does it cost on a monthly basis to service your mortgage, make those payments, credit card debt, student loans, auto loans, all of that, put that together and then scale that to your income. We basically haven't been lower on that leverage metric for about as long as the data goes back, which is 40 plus years. So again, we are in a very, very strong place from a consumer perspective. Yes, we've seen it moderate a little bit, but that makes sense as we've kind of recovered in the economy, kind of gotten off those extreme lows from low leverage and normalized back to something where we were prior to the pandemic, which again was a very strong level. So there's a lot of headlines around the consumer starting to show some cracks, but as we dig into a lot of the data, a lot of what's happened over the last couple of years is just a normalization after the pandemic shock. And we're normalizing back to a point where consumers were in a very, very healthy place. So I think that's really the key takeaway from our perspective.
Yeah, we agree. Changing gears a little bit, I think you're on the investment committee at Natixis too. So I'm going to throw an extreme kind of example at you, just because being in the trenches, we get some unique questions. So I'll throw this one at you. With CDs being in the 5% range, why don't I just sell everything that I own and just buy CDs and throw it at a CD for right now? How would you kind of address that, like in regards to investment philosophy, sell everything and just go into CDs?
Yeah, well, I mean, I think the easiest answer to that is, our 5% rates for a short amount of time, is that going to get you to your long-term, goals from a savings and investment perspective? Probably not. And keep in mind, those rates, you have to hold that for a full year to earn that 5%. So that's where I think you need to start thinking about opportunity costs. Think about if you earn 5% over the last 12 months. Sounds great until you realize you could have made 25% in equities, right? there's a lot of opportunity cost to be had there. And I think you need to take a much longer term perspective in terms of your actual savings goals here. That's just not going to cut it, getting 5% over a short amount of time. And keep in mind, there's still a lot of fears about a hard landing or a recession looming in 2024. That would lead to rate cuts, right? And now you're going to start getting lower and lower rates on, short, treasury bonds or your CDs. But even if we didn't have a recession, you're probably going to see some marginal cuts from the Fed, because if inflation continues to move back towards its target, they don't need to be so restrictive anymore. And so either way you kind of cut it, this is kind of a short window where, those rates sound pretty attractive. But again, you need to hold it for 12 months. And if we're in an economy that's still holding up pretty well here, that means that it's probably still a pretty favorable backdrop for equities to outperform. Again, it's not going to be a straight line. That's kind of the name of the game with equities. You're going to get pullbacks. You get about 5% pullbacks every year. You should expect 10% pullback every year. That's kind of just par for the course here. But if you're just going to crowd into, CDs at 4 to 5%, you're giving a lot of opportunity on the upside for equities over the longer run.
That's a lot to unpack. It's really, so I hopefully, and if people on the call, if you have questions about this, call up and we'll go over it. But opportunity cost, and then that was powerful in regards to, it's an annual APR, not a 3-month APR. That people get confused with that a lot. So I'm glad that you actually pointed that out. Switching gears just a little bit, you mentioned inflation. Do you have any thoughts about that, or what's the Texas kind of think in regards to inflation? I know you mentioned it earlier in the call, but what are your guys' thoughts around that?
Yeah, that's a topic we could spend probably 2 hours on, but the short of it is, a lot of the trends, and basically I think the way to think about the entire economy is that it's just a continued normalization after that pandemic shock again. And so when you think structurally what's changed, I would argue not a whole lot. And so when you think about what's really been the driving forces behind inflation, the Fed kind of boils down to 3 baskets. It starts with core goods. And again, going back to our comments, a lot of the spending early in the pandemic got redirected from services into goods. You saw a huge surge in goods inflation early on, and that's basically faded. And it's basically back to oscillating just between a little bit of inflation and modest deflation from a month-to-month basis here. And that's where we were really for the 20 years coming into the pandemic. So I'd say largely that's normalized. So then the next 2 components to really look at that the Fed's focused in on is the housing market. There's some weird quirks in terms of how housing inflation is measured, but just the key takeaway is it's not driven by home prices. It's really driven by rents. And when you take a look at what rents have done, market rents right now, they're actually in negative territory on a year-over-year basis. They're actually outright falling, and that takes about 12 months to filter into the data. We saw some weakness in the back half of last year. That's just starting to filter into the data now. And as you look into the weakness that we've seen throughout this year, that should continue pressuring housing inflation lower as we move into the next year, and potentially even beyond when you look at how much new supply of multifamily units is looming. We're actually at historic all-time highs for the amount of multifamily units under construction. So that matters because it's about 40% of that core inflation basket when you strip out food and energy costs, which is what the Fed really looks at. And that's going to have a long road lower for continued disinflation, so falling in the pace of inflation. So basically, it just boils down to the Fed just looking at labor markets. And again, it's more of a story of normalization on that front. You're seeing a lot of that tightness start to fade, not a weakening labor market, but just kind of normalizing to a healthier labor market where wage pressures are falling. And I think that's the kind of last key that the Fed's looking for here. So there's still going to be some volatility on a month-to-month basis, and I think that's probably how you could sum up the most recent CPI print we got this week. But the trend is still moving durably lower, and so I think it's a real possibility we could be looking at maybe 2.5% on inflation by early next year, with some signs maybe pushing a little bit closer to 2%. So it's not a done deal by any means, but a lot of the trends are moving in the right direction. Don't get hung up on those year-over-year numbers. Those are still largely a reflection of some of the impacts from last year. But if you look at more recent inflation prints, they continue to basically normalize around 2%. So we're certainly encouraged on that front. Again, a little bit more to go, but the Fed is basically telling you that they're comfortable with that trajectory, and then they're ready to kind of pause and see how the data unfolds from here.
That's awesome. The housing number, I love that you brought that up, because when people realize that it's off the rents as opposed to anything else, they're like, whoa, mind blown. Like, what is this? So I don't know if you tell me if you're comfortable talking about this, but you guys have a unique strategy with direct indexing and tax loss harvesting. Are you comfortable kind of touching a little bit on that? Or because we think that's so powerful in regards to, especially with business owners and some of our higher net worth individuals, that concept of direct indexing. Are you okay with going into
Yeah,
that?
I can certainly touch on that a little bit. Not really my area
Gotcha.
of expertise on a day-to-day basis, but certainly can chime in with some thoughts there.
Okay. So let's pivot to a different area then. Let's go to, is there, I've been doing this over 25 years or maybe 27. I can't remember. It's kind of blending together, but I always hear it's different this time. It's different this time. Everything's different this time, right? Everything's different. But is there anything that's out there that's kind of that you guys are excited about, or that you're looking, hey, this is pretty cool. We're excited in this area. Is there, what's kind of in the note, like on something positive and that we're kind of excited about going forward here?
Just broadly, or in terms of investment ideas, how do you
Either
want
or,
to
wherever you
focus
want to
on
go, wherever you want to
that?
go with it, Garrett.
Sure, sure. Well, I guess I can touch a little bit on both of that. I think that there's always going to be people pushing back on this idea that, oh, this time is different. So maybe we can just say, well, this time's not quite the same. And there's a lot of support to suggest that it's not. I mean, if you go back to why we are where we are, do you really think it's meaningful to compare once in a century pandemic environment and a recovery to, financial crisis or kind of more run of the mill slowdown and recession? Probably not. There's probably going to be some unique dynamics at play. And I think, again, that really does explain a lot of why many of investors have been so confused by the economy and the markets over the last couple of years. One of the things I think is really, different or not the same this time is the fact that a lot of people assume that the Fed tightening so aggressively over a short period of time would, inevitably derail growth. And I think what we've seen, again, kind of to that comment on consumption, is being driven by incomes. And that's different than a typical cycle, which tends to be very much driven by credit. So companies seeking credit, consumers, taking on more leverage. That tends to be kind of the lifeblood of economies is credit growth. But what we've seen is it's actually just, organic income growth that's been driving the economy. And I focus on the consumer so much because that's 70% of our economy. We're a consumption-based economy. And so what the consumer does generally tends to drive the rest of the economy here. And, from that perspective, I think what we've seen is the economy is just not as rate sensitive as we think it is. There's still a lot of, again, cash still out there. So if you have a lot of cash, you don't need to take on leverage, and higher rates don't bite the same way as you might otherwise think. And so what we've been stressing for, over a year now is that a lot of the reasons that growth slowed down, in the early part of 2022, all those headwinds, be it fiscal drag, so higher tax bills for consumers, less, transfer payments, so stimulus checks or unemployment benefits. You take a look at the tightening that came from the Fed. The effects on the housing market that basically ground to a halt last year. All of those dynamics are basically flipping, and they're becoming much more supportive for growth, which is why we've been much more optimistic on growth accelerating this year, and that's exactly what we've seen. That said, I think there's some dynamics that are starting to soften out a little bit, so don't expect us to accelerate to 4 or 5% growth into the future. But ultimately, I think it speaks to the fact that the economy is very resilient. It can handle higher rates, and ultimately tying that back to opportunities in the investment universe. Again, that opportunity cost, if you're looking at CDs, I think this is still a very positive backdrop for corporations to be generating strong profits and ultimately supportive for equity markets to continue moving higher. Again, not in a straight line. There's going to be pullbacks here and there, but I think we're encouraged by, that cyclical nature in the economy where growth is actually doing well, and a lot of those areas of the market that are sensitive to growth. So think of areas like, materials companies, industrials, even financials to an extent, and then technology, very much cyclically oriented. I think those are areas of the market that stand to do pretty well here. All those classic defensive sectors that, did well in 2022. I think this is a different backdrop, and you want to be a little bit more, cyclically oriented in equities. And that would certainly go against all those fears of a looming recession in 2024.
Right. So that was a lot of stuff to unpack. I think one of the key ones, though, if everybody caught that, 70% of the consumer drives stuff, so which is kind of powerful. You mentioned growth a lot, and I'm going to try and end on this note. So because again, a lot of times it being in the trenches, we get extremes, inside there. So there's a big push now that value investing is dead. Don't go value investing, go all growth. Would you ever recommend just to kill one area to go to another area, or you guys kind of recommend being spread across the board and sticking to a diversified concept and overweighting one way or another?
Yeah, I would say you can go a little bit too far with diversification, and you can kind of turn it into diversification, so you can actually detract from your objectives. I would say that there's some validity to having a little bit in kind of both camps, but I would be pretty specific. Value is, it's generally viewed as value versus growth. But there's more nuance than just that. There's a couple different types of value, and that's why I specifically mentioned this idea of cyclicals versus defensives.
Yeah.
So from our perspective, I think there's value to having value in your portfolio, but you want to be skewed towards those cyclically sensitive parts of that value sector, or complex, I should say. So a little bit of both, but I think, again, a strong economy that's holding up, even if it starts to decelerate a little bit as we move into 2024, I think benefits both sides of that equation. Growth, certainly, but also some of those cyclically oriented sectors within value.
I love that diversification. I'm going to use that one too. That's good. So we're coming a little bit past the time frame here, but I want to thank Garrett for taking time out of your Friday, excuse me, I'm getting ready for the weekend. I'm ready for Saturday. So take time out of his Saturday morning to kind of join us. And again, the concept behind this is these are the people that help us guide the decisions in regards to stewards of your money. So we kind of want to bring them to the forefront with you too. So thanks, Garrett. Have a good weekend. Everybody else have a good weekend too. Thanks, everybody.
Thank you. Take care.